The market is completely wrong about Visa stock. The company's stock price is down 8% in the past year, despite re-accelerating revenue growth to 17%. There are serious concerns about stablecoins and government-backed competitors. I'm going to show you exactly what's going on inside the business to find out if Visa stock is a buy at today's price. I'll also show you what I think the stock is worth towards the end. The first thing to understand about Visa is its toll booth business model. The same way that a toll booth collects fees when you use the freeway, Visa collects a fee on the $15 trillion that traveled through its network in the last 12 months. It's important for investors to know how the network works so that we can understand why Visa's moat is so strong. There are 4 key participants in the Visa payment network. First, we have the cardholder. This is your everyday consumer shopping in Costco or ordering on Amazon. Whenever they make a purchase with their Visa debit or credit card, the second key participant, the merchant, in our example Costco, has to send the transaction to their acquiring bank. The acquirer is the third key participant, and they are essentially the bank of the merchant. So basically Costco's bank. The acquirer then processes and requests authorization for the payment from Visa's network. Visa conducts all of the necessary security checks to reduce the risk of fraud, and then requests confirmation from the issuing bank, which is the fourth network participant. The issuing bank is the bank of the consumer who's making the purchase in Costco. They're known as the issuer because they're the bank who issued the card to the consumer. For example, JP Chase. The issuer verifies the account status and available funds, then sends approval or rejects the request from the Visa network. Once approved, the transaction is complete and the funds are settled between the acquiring and issuing banks within 24 to 48 hours. Visa and their main competitor MasterCard operate the 2 largest payment networks, which processed $24 trillion worth of transactions in the last 12 months, making them the de facto arteries of the modern capitalist system. If Visa or MasterCard disappeared tomorrow, the word crisis doesn't even begin to explain the turmoil that would ensue. Now, if we take a look at Visa's fundamentals, you'll see just how much of a financial powerhouse the company is. In the past 12 months, Visa produced $21 billion in free cash flow. Free cash flow is the money left over after all expenses are paid for. Visa can use this free cash flow in any way they like. They can pay a dividend, which they do. Visa is probably one of the best dividend growth companies in the world, with their quarterly dividend increasing at an annual rate of 17% over the past 10 years, from 14 cents per share back in Q2 2016 to 67 cents per share in Q2 2026. But as we can see from this chart here, dividends are only a small part of Visa's overall shareholder return, with just under $5 billion worth of dividend payments in the last 12 months, compared to over $21 billion in share buybacks. Share buybacks are another way that public companies can return profits to shareholders. By decreasing the number of shares outstanding, the remaining shares become more valuable. As we can see from this chart, Visa has bought back its own shares at an annual rate of 2% in the past 10 years. And then if we look at Visa's free cash flow margin, this is the percentage of their revenue which converts to free cash flow. You can see that it usually hovers around 50 to 55%. That is among the highest free cash flow margin of any public company. To show you just how insane Visa's profitability actually is, we can compare Visa's free cash flow margin to that of Microsoft and Alphabet. Microsoft's 23% free cash flow margin, represented by the orange bar, and Alphabet's 15% free cash flow margin, represented by the red bar, pale in comparison to Visa's 49% free cash flow margin, represented by the blue bar. You could double Microsoft's free cash flow margin and it still wouldn't match Visa. Next, we're going to look at some of the tailwinds affecting Visa's business. Tailwinds are trends in the global economy that positively impact the business. We need to know the tailwinds affecting Visa's business to understand how they're able to consistently and predictably grow their revenue at 10 to 15% annually. The first major tailwind affecting Visa is digitalization. The global economy is slowly but surely transitioning from cash-based payments to digital payments. Visa, being the largest global payment network, is best suited to benefit from this transition. You also have the growth in e-commerce, with the likes of Amazon dominating online shopping. E-commerce only expands the potential for consumers to purchase the things that they need and want, meaning Visa will continue to see rising payment volume. Visa's second major tailwind is cross-border payments. Cross-border transactions are more profitable for Visa than local ones because the payer and the recipient are in different countries, which increases complexity. This isn't just for consumers, but also for businesses who buy goods and services from other companies in foreign nations. Therefore, as globalization continues its relentless march forward, Visa will benefit. Visa's third major tailwind is business-to-business payments. Traditionally, businesses sent an invoice and the recipient would make the payment via bank transfer. For cross-border, the payment had to travel through multiple intermediaries, which increased cost and took days for the payment to settle. But now Visa has introduced its own business-to-business payment network, which allows banks to send payments directly to each other. As Visa's share of the business-to-business cross-border payment market grows, so too will its revenue. Before we take a look at Visa's current valuation, we have to acknowledge the threats that the business currently faces. The first threat to Visa's business is the emergence of buy now, pay later services from the likes of Klarna, Afterpay, and Affirm. The problem here is that these buy now, pay later firms sit between the consumer and the merchant. If a consumer pays for their online shopping with Klarna instead of a Visa credit card, Visa loses out on that transaction fee. However, Visa is combating the threat from buy now, pay later firms by providing their own buy now, pay later options. And the buy now, pay later firms already use Visa's network in multiple ways. So the growth of buy now, pay later really just provides new customers for Visa's existing business. The second threat to Visa is the adoption of stablecoins. Stablecoins disrupt Visa by enabling instant payment settlement with no intermediary and near zero transaction fees. This directly threatens Visa's international transaction revenue, which is one of its highest margin segments. However, Visa is actually integrating stablecoins for payment settlement. So rather than a threat to Visa, stablecoins are becoming part of Visa's infrastructure. And then the third and strongest threat to Visa's business is government-backed alternatives. Visa, being an American company, is seen by foreign governments as a threat because it controls the flow of money in their economies. Therefore, nations like Brazil and India have developed alternatives to Visa and MasterCard, which are becoming very popular. However, while government-backed networks threaten Visa's domestic debit business, the company is shifting towards value-added services, cross-border and business-to-business payments. These are areas where Visa is experiencing the most growth, and Visa is actually partnering with these government-backed networks. Next, we're going to look at Visa's valuation. Then we'll build our valuation model using Qualtrim's DCF calculator. This will tell us what kind of return we can expect if we were to invest in Visa stock at the current price, around $330 per share. Full disclosure, I currently hold Visa stock in my own portfolio. It's my fifth largest position at a 10% weighting. Visa's price to earnings, or PE ratio, currently sits at just under 29, which is almost identical to its closest competitor, MasterCard, which currently trades at just under a 29 PE. If we look at Visa's PE from a historical perspective, we can see that since the peak in 2021, the company's PE ratio has fallen dramatically. The stock is currently trading at its lowest PE multiple since 2022, around the time that central banks across the globe began raising interest rates to combat inflation. And then in terms of free cash flow yield, Visa currently trades at 3.4%. If we compare this to Visa's closest competitor, MasterCard currently trades at a 4% free cash flow yield. This means that MasterCard is slightly cheaper than Visa, because a higher free cash flow yield means the stock is cheaper, and vice versa. From a historical perspective, Visa's free cash flow yield tells an almost identical story to its PE ratio, just inverted, with its free cash flow yield reaching 2% back in 2021, the most expensive it's been in the past 10 years, compared to today, where Visa's free cash flow yield is near its high point. Now let's head over to the DCF calculator on Qualtrim to find out the return that Visa stock could produce for investors if bought at today's price. We have to come up with assumptions for Visa's earnings per share growth rate over the next 5 years, and an appropriate PE multiple for the stock to trade at. Analysts are projecting 12 to 14% annual EPS growth for Visa over the next 5 years. Visa is such a consistent and predictable business due to the tailwinds that we discussed earlier, so the analyst estimates are probably not far off. However, due to the rapid growth of Visa's value-added services segment, I believe that Visa could grow EPS even faster. And then if you factor in enormous buybacks at an historically low valuation, it seems reasonable for Visa's annual EPS growth to accelerate to around 15 or 16%. I'm going to use 15% in our model. And then for the PE ratio, I'm expecting some multiple expansion, meaning an increase in the PE ratio that Visa trades at. Like I mentioned before, Visa is currently trading at the lowest level we've seen since 2022. The median PE ratio for Visa stock over the past 10 years is between 32 and 33. For our model, I'm going to use a 30 PE ratio. Based on these assumptions, we could see Visa stock increase from $330 per share today to $640 per share in 5 years from now. That's a 14% annualized return, almost doubling in price over 5 years. But I also wanted to provide some more bullish estimates. The assumptions I've gone with here are 16% annual EPS growth and a 32 PE ratio. These more bullish assumptions suggest Visa stock could increase from $330 per share today to $715 per share over the next 5 years. That's a more than 16% annualized return, more than doubling Visa's stock price. So as a Visa shareholder with more than 10% of my portfolio invested in the stock, I'm very confident in market-beating returns over the next 5 years. I would rate the stock a buy at today's price of $330 per share.